Tom, I don't know if you had anything to add.
So just a few questions, some pretty simple. One, I'm just kind of curious, I can probably find this on a news article. Where are you seeing the most amount of volume of opportunities come out of the United States right now? And then maybe just more holistically, maybe if it's outside the United States, which other countries? I know like Israel is very heavy right now in a lot of tech innovation. Two, I'm curious to know if there was one main attribute that you look for in opportunities, what is it? And then just why?
Yeah, so maybe answering the last question first, I'd say if I had to pick one, and of course we look at a multitude of factors, but rocket person founder or founders would definitely be number one. At the end of the day, it all comes down to people. Everything else we look at is driven by the people, who are founding and running the company. So any metrics, any, market size, any competitive analysis, et cetera. If you have really great people at the helm, they'll have done that thinking and made good decisions around that. So definitely people. It's not an original answer. I think many investors will tell you that. In terms of sectors in the U.S. and abroad, in that 80% of our portfolio that really focuses on B2B software, we do like a few themes. So vertical and horizontal SaaS, fintech, digital health, and industrials are probably our main four, and see a lot of activity in the U.S. And abroad. We being early stage investors and being so people driven, we also give ourselves the flexibility to be opportunistic and back great founders doing things that we don't expect. And so, we do have an opportunistic lens too, and end up sometimes investing in, deep tech moonshot bets and hardware and things that we don't have a thematic focus on. We just, for example, announced our first investment in a quantum computing company, which is about as hardware and moonshot as you can get. We're very excited about that one. So, and then abroad, there are some similarities, I'd say, but there are also some differences. So, we have boots on the ground in Singapore and India at the early stage fund. They look at some of the same categories that we do, but they also, there are some, I'd say, categories that are more prevalent and more dominant. So for example, marketplaces are really big in emerging markets. I think, if you look back at the US's history, marketplaces were really huge in the, early waves. They're still big, obviously, but then, you have a shift towards, SaaS and other types of companies as well. And so, and then, the nice thing about being a global investor is you also start to see similar business models that are across different regions. You can start to pattern match on that. And so you might, have a company that is a D2C healthcare company in the US, and then you have a pretty close analog D2C healthcare company in India, and something about how that business scales, the economics. You obviously have to adjust it for the market, but it's nice to be able to recognize those similarities. So, you mentioned Israel. India is a very, I think, a very interesting market as well. And we do a lot in Southeast Asia. And Latin America, I'd say, is one that, we're diving pretty deeply in. And we have a China fund. So, that's kind of very specific. There are obviously some unique things to take into account when investing in China. And Europe is very active as well. I mean, that's the exciting thing about being global, is that all of these ecosystems are really starting to take root in a way that I think will be kind of really fruitful for the coming decades.
Has this environment on a macro level changed the way that you guys analyze and seed investments going forward? What has that done? Because other than, valuations certainly making things probably more affordable, that's for sure. But give me a little insight into what pivots or trajectory changes you guys might have made.
Yeah, it's a great question. And the answer is still evolving, I would say. But I'd say, we are focusing more on kind of credit quality and credit risk. If a business has that in their business model in some way, shape, or form, lending platforms and that kind of thing. Cost of capital, we're focusing more on that, just given the rising interest rate environment. So these are always risks, but of course, when cost of capital is really low and there's a lot of money sloshing around, it's easier for companies to scale. And then we look at, industries that are both countercyclical to recessions and are hardest hit by recessions, to understand just kind of what the risk profile is for a company on an industry perspective. So if you're selling to restaurants, for example, versus versus manufacturing, right, you might have different risk profiles. Frankly, we try to take into COVID into account as well. Going back to the restaurant example, right? Like, hopefully this is the last big global pandemic we lived through, but certainly like the effects of shutdowns on businesses have been, really impactful. So, but I'd say on the macro recession front, it's on the analysis side, it's mainly about credit risk and cost of capital. And then to your point about valuations, we try to just, be a fair and adjust to the market, where multiples are today and price according to that.
So with cost of capital, before I want to shift the conversation a little bit to the individual investor, but when you talk about cost of capital, do you guys look at perhaps bringing in venture debt to perhaps, bring down whether it's dilution or the cost of capital? I mean, how do you manage that cost?
So there's two separate categories of debt that we deal with most commonly in startups. One is venture debt, which is usually done alongside an equity round, meant primarily to extend runway. Sometimes you have to draw it, sometimes you can keep it more as an insurance policy. And cost of capital is definitely relevant there because the interest rates are typically floating, and they have gone up. But that's kind of less critical to a company's core business model, and it's more about runway and cash optimization. The second category, which is more fundamental to a business model, is debt facilities that a company will rely on to generate revenue. So, for example, in the buy now, pay later space, a company will often raise equity, and then they'll raise a debt facility that is usually much larger than the equity round in order to make loans. And those interest rates are also typically floating and have gone up. And so, your unit economics and your net interest margin in that kind of business can go upside down or stay upside down longer if your rate ticks up every time the Fed increases their rates. So I think that second category is where we spend more of our time, and the first category is more of just adjusting to new market conditions.